Relaxo Footwears volumes dropped last fiscal owing to a steep increase in raw material prices, GST rate hike, as well as channel destocking. FY22 volumes, however, were marginally lower even compared to pre-COVID levels of FY20. With mobility increasing post the drop in COVID cases and channel partners restocking inventory, we expect growth in volumes in FY23. Also, the raw material prices have stabilized, and with Relaxo passing on majority of the cost increases, we expect margins to improve in the current fiscal as well. Relaxo is the only listed player in the low-priced value for money footwear with an average realization of about 200 rupees. The footwear segment, especially low-cost segment, is unlikely to see material impact on demand owing to inflationary environment. With strong brand image, zero debt on books, and enhancing distribution presence, Relaxo is well poised to gain market share in the long run. Relaxo's revenues dropped 6% YOY in Q4 FY22. The drop in revenue was volume-led, which declined 26% on a year-on-year basis. Restrictions owing to the third wave of COVID-19, increase in the GST rate on footwear below 1,000 rupees, as well as subdued consumer demand owing to inflation affected the volumes. Meanwhile, realizations improved by 27%, mostly owing to price hikes due to higher raw material prices. Also, better product mix led to some improvement in the realization. Gross margins dropped with steep increase in raw material prices, both crude as well as rubber-linked. Due to increase in the GST rates in Q4, Relaxo refrained from taking further price hikes. Operating deleverage owing to a drop in revenue led to a 600 basis points dip in EBITDA margins. Relaxo also provided support to channel partners on GST rate differential on their inventory in March 22 quarter, which also affected the margins. Net profits, meanwhile, dropped 38% year-on-year. COVID-led disruptions, sharp rise in raw material costs coupled with increase in GST rate on footwear affected volumes, which degrew 8% in FY22. Also, channel partners resorted to destocking their inventory in the wake of increasing prices, which put further pressure on volumes. As per the management, the older channel inventory with lower GST rates has been liquidated, and channel partners would now resort to filling the inventory once again, which should drive volumes. Demand is also expected to be higher with increased mobility post-COVID. Management expects recovery in volumes Q2 FY23 onwards. We expect Relaxo to clock high single-digit volume growth in FY23. Relaxo is expanding distribution reach with focus on increasing presence in the western as well as southern markets. It enhanced retail touchpoints to about 60,000 last fiscal, an increase of about 20%, and aims to further scale its presence in the future. Relaxo is also opening EBOs and ramping up exports, which contribute about 7% and 4% respectively to revenues. Apart from the offline presence, Relaxo is also ramping up online presence by adding new partners, focusing on choosing the products for online sales, and increasing marketing spends on the online channel. The current contribution from online is about 11%, and the company looks to enhance the same. After an initial spurt post the Russia-Ukraine crisis, crude prices have cooled off and are now trading around $107 per barrel. Also, natural rubber prices have come off from the highs witnessed towards the end of 2021. Hence, crude derivatives and rubber-related raw materials have stabilized, and the company has stated that raw material prices seem to have peaked out. Relaxo has already effected price hikes of more than 20% in the last fiscal, passing on a large part of this cost increase. With stabilizing input prices and pickup in volume growth, we expect Relaxo's margins to improve in FY23. Management is targeting pre-COVID EBITDA margins of about 17% in the current fiscal compared to margins of 15.7% in FY22. At the current market price, the stock is trading at a PE of 60 times its FY24 projected earnings. Investors can utilize market weakness to add the stock to their portfolio.